welcome to Sectors Up Close. I'm Elena Casas. Today we're talking big tech, and my guest is Keith Gangl, Portfolio Manager at Gradient Investments. It's been a turbulent 2 weeks in Silicon Valley. After the collapse of SVB, banker to many startups left founders scrambling to move their cash. Meanwhile, at the giants of the industry, the layoffs keep coming. A further 10,000 were announced last week at Meta, just weeks after a previous round in January, and 10,000 more jobs went at Microsoft. But has that cost-cutting left leaner tech firms better positioned for a downturn? Some investors do seem to think so. This is the S&P 500 Communication Services Index, where Google and Meta are by far the biggest players. It's up about 14.5% in 2023 to date, when the wider S&P 500 has given up virtually all its gains for the year. Well, to find out why, I'm now joined by Keith Gangl, Portfolio Manager at Gradient Investments. Keith, we're living in rollercoaster times in the markets in recent weeks, and investors are looking for a safe haven. But is big tech that defensive play?
Yeah, we believe it is. So last year, that space underperformed pretty dramatically. It was down over 30% a lot of these names. So we think valuation's been reset. These large cap tech names have a defensive moat. They're technology leaders in the space. They're big cash producers. Valuation's reasonable. We think they have a nice setup for next year. Again, as the economy starts slowing, people start worrying about growth. People are willing to pay up for secular growth names, and that's where we think these large cap tech stocks play.
How will Fed policy make a difference going forward, though? Of course, it seems anybody's guess at the moment whether the Fed will hike again this week or whether they'll hit the pause button. But these growth stocks have been hit hard by the rate hiking cycle, haven't they? So what if the Fed does go further?
Yeah, we're not exactly sure what the Fed's going to do. Like you mentioned, the odds of them raising rates by 25 basis points are slightly increasing here. I think it's a little over 50%. So again, we're not sure. But if we back up 2 weeks ago, the Federal Reserve indicated that they're going to raise by 50 basis points. And we think that's off the table. Maybe it's more like 25 basis points now. But we think as for large cap growth names, they underperformed last year. We think whether they raise 25 basis points or not, these are set up well for this year going forward. Again, as economies are slowing, people are going to look for secular growth names, and these perform well in that kind of environment, again, regardless of what the interest rates are going to do.
You mentioned economies slowing down everywhere. We have already seen, of course, tens of thousands of job losses at these tech giants in recent months. Is that cost-cutting cycle coming to an end, or are we still going to see them forced to cut back further?
I think they can cut back a little further, but I think we've seen a majority of it as well. You mentioned in your start of your show is how Meta's laid off, 10,000, 11,000 for the last 4 months, which is a lot of employees. But again, if you look from 2020, they've actually doubled their employee base. And so when they laid off 11,000, that was about 13%. So again, even with these recent layoffs, they are still a lot higher than they were a few years ago. And that's the same for the industry. Microsoft has done 10,000, but they're still hired a lot more in the last couple of years. So they can become a little more efficient and lay off little employees and be better set up for markets going forward.
Do you think that Meta specifically is regaining the confidence of investors because they largely weren't sold on the metaverse idea, and the company has been struggling, hasn't it, to attract younger people to Facebook and Instagram?
Yeah, exactly. We think obviously they're going to still focus on the metaverse, but they're going to refocus on their Facebook. They have Instagram. They have Reels, which competes, like you said, with TikTok, which the younger demographic seems to be rotating towards TikTok. But they're putting a lot of money in there. We think they can gain back share. There's also the possibility, which we think is a probably lower probability of happening, is banning of TikTok in the U.S. You're starting to see bipartisan kind of legislation kind of getting introduced. Again, I'm not sure if that's going to happen or not, but that's a potential catalyst that's not priced into the stock as well.
What are your tips then for investors in this space? How should one be approaching big tech at the moment?
Yeah, we like the space at all. We like Amazon, we like Meta, we like Google as well. We like them all, these big players. So again, they all have something different to offer. They've been trading at valuations that are historically lower end of their range. Like I said, Meta's trading at 16 times for 18% growth. Google or Alphabet's trading at, again, 16 times for 20% growth. Amazon sold off for several years due to their capex, over hiring and employing too many people. We think that slows, and that's going to be a great opportunity to own Amazon. Amazon's obviously driven by AWS and their consumer side of business. Consumer unemployment here in the U.S. is still relatively low at 3.6%. When people have money in their pocket, they like to spend. We think Amazon will still be a key leader in the retail space.
Well, thanks so much for that insight, Keith Gangl, Portfolio Manager at Gradient Investments. Well, that's our look at big tech. I'm Elena Casas, and this is Reuters.